Is the income back in fixed income? On the equity side, how can investors diversify the top heaviness of the S&P 500? Welcome to ETF Perspectives Live, podcast style, where we supplement our Q1 2026 ETF Perspectives publication with a little conversation. Hi, my name is Dave Sharp, a director on our ETF Capital Markets team, and I'm with Brad Collins, a fixed income client portfolio manager. I've been lucky enough to be working with Brad for 10 years now, so I'm really looking forward to the conversation today, Brad.
Yeah, likewise. Time flies.
Yeah, it's crazy.
Yeah.
So let's get right into it. So Brad, let's talk fixed income first.
Yeah.
So we're getting back to basics in bond investing in 2026.
Yeah. And look, I think before we jump into our bond outlook for 2026, I think it's worth just doing a recap of how we've kind of got to this point, right? So if you look at advisor portfolios today, you can tell that a lot of the positioning is being influenced by what happened in 2022. Dave, do you remember what happened in 2022 in the bond markets?
I try to repress most of that, Brad, but I remember a little bit of it.
Yeah,
Tell
exactly.
us more.
So I've been calling it the 100-year bond drought, right? So it was the worst year on record for the U.S. Ag. We had negative 13% total return. So the next worst drawdown was negative 2%. So just an outlier type of situation in bond markets.
And what was the time frame for that again?
Over 100 years.
Wow.
Over 100 years. So it was a century of data that you basically pull for the ag.
Wow.
So the worst year on record. And it was obviously, why do I bring that up? It was a painful time in bond markets, but I think that needed to happen in order to reset the yields in bond markets and really restore the role of bonds in portfolios. So, at Vanguard, we've been saying for the last 3 years, like we've entered a new era for fixed income. And this doesn't happen overnight. There's a transition period that has taken place. So if you think about, coming out of 2022 when the Fed hiked rates for 800 days from 2022 until almost the end of 2024, the spread between the 2-year yield and the 10-year yield treasury was inverted. So you're in an inverted yield environment, which is not normal for bond markets, right? And during that time frame, cash was king. So money market yields were out yielding the yield on the U.S. Ag. So, yields have been back for a while, but you've just started to see normalcy return to the bond markets.
Yeah, makes sense. So how about 2025 though? We did see some stabilization in the bond world, right?
Yeah, so 2025 was one of the best years we've seen for bond markets. So 7+% total return. Term premium started to be baked back into the market. You saw the yield curve, the spread between the 2-year yield and the 30-year yield steepen out dramatically. So 2-year yields were down almost 80 basis points last year. And, most importantly, when I think about what do we take away from last year's bond returns, it's that 60% of the return was income driven. So it's, an advisor, a client, an investor with a bond fund in their portfolio that's just clipping a coupon. And the good news is, and like the key message to advisors is we should expect to see that, or we at least expect to see that going forward being an enduring trend. So the role of bonds in the portfolio, that dual role that they typically play as an income lever, a diversification lever, we believe that will continue going forward.
Excellent. Okay, so what I'm hearing is it's time to rethink or revisit the role of bonds in your portfolio then at this point.
Yeah, so and I kind of keep going back to just getting back to the basics. And there's been obviously hesitancy from investors to do that, again, as we talked about what has been going on in the bond markets over the last 3 years. But if you kind of just face the facts today, if you look at the Fed's cut 175 basis points since the end of 2024, the yield that you pick up going from an ultra short bond product to a core bond product, that's almost 80 basis points. So that would be our recommendation. Our recommendation would be to think about and consider, the money that has the massive amount of money that's moved into the ultra short bond space, consider moving that into a core bond fund potentially. You're capturing that additional yield. You're taking on a little bit more duration risk, some credit risk, but it's diversified credit risk. And our investment strategy group, they've been saying that we expect to be in this higher yield environment for longer. So I think that's good for advisors that are looking for durable income in their portfolio and a diversification lever for equities.
Awesome.
Yeah.
That's great.
So why don't I flip it back to you? So when I, reading ETF Perspective this quarter, one of the stats that stood out to me was 41% of equity ETF inflows went into 4 products. So being a bond guy, I come from a decade of bond investing, very fragmented market. That stat is pretty eye-popping to me. So I would love to just hear your thoughts on how do you interpret that? How do you digest that?
Yeah, I mean, an incredible year for the S&P 500, just in general, but the flows into those funds, as you said, we had record-breaking flows into ETFs last year, and for 41% just to go into 4 products is pretty shocking to see. I mean, there's 4,700 products in the market these days, so really incredible, that top heaviness. And I think the reasons for that are really generated around, there's some client familiarity that plays a big part, right? If you're watching business news, they're talking about the S&P 500 every day. What's the S&P 500 doing? So there's some brand recognition just in that index itself as something that clients understand, and they know what it is, and they've heard of it. So when they come in and they're maybe new to investing, that's an easy place to find, an opportunity to invest.
Right.
I think that it's also just the performance that we've seen. The last 5 years, ending last year, was close to 15% annualized return. That's incredible return that clients are seeing, specifically in the S&P 500, that was outperforming some mid and small caps over that time period, which just created a bit of this top heaviness. And I think the third thing that's just really important is the total cost of ownership that exists in those products. They're very liquid, some of the most liquid products in the world. If we take VOO, Vanguard's 500 index, it's only 3 basis point expense ratio, and the spread is only about 0.5 basis point. So for 3.5 basis points, you could buy, hold, and sell that ETF in a single year. Again, that's $3.50 for every 10,000 invested. That is, how incredibly cheap it is to be able to be invested in this familiar index that's shown really great performance. And I think that's really driven a lot of its growth.
Yeah, I mean, I think that just shows like how the evolution of the ETF market and how mature it's gotten, right, to be able to do.
Yeah, I mean, the liquidity profile for some of these funds, they're the largest fund out there, trades over $2 million per second on a trading day.
That's crazy.
VOO is over $4 billion a day on many days that it trades. It's just that liquidity profile makes it really easy for clients to get in and out at a very cheap cost. And we all know that, it's been famously cheap to invest in Vanguard products for a long time as well.
Yeah. So the famous line is, historical performance doesn't guarantee future performance. So, if you think about all the money that has piled into S&P 500, maybe it was performance driven to some degree.
Yeah.
Are clients at, a big risk of the concentration?
Yeah, I mean,
within the 500
great
biggest
question,
stocks?
because it certainly is something, the concentration that we see there across a few different, attributes. One is just market capitalization, the mega caps, the success that they've had. 7 companies make up almost 40% of the S&P 500 now, right? There's 500 companies in that index, obviously, and only 7 of them make up this huge portion of it. So just that, top heaviness of the mega caps is significant. From a style standpoint, it's really lent a lot to growth over value over those last 5 years. A lot of that performance is attributed to those really big companies, and they're all growth oriented. So that style mix is really pointed to growth and not as much of a blend. And then, lastly, I would say that the sector diversification now, with technology being a driving force, those 7 companies are all tech names that make up that 40%. So it really creates this really large portion of that portfolio that is in, technology names, where we know that it is important to diversify across all the major sectors, but you're now just heavily weighted into mega cap growth technology names in that index at this point.
Interesting. Okay. So we're obviously on the road a lot. I don't know, what's your most recent trip you've been on?
Yeah,
visiting clients.
Yeah, I think the last one I was just up in New York, visiting with some clients up there and talking to them. And, the good news here, right, is that I think that we are seeing clients that are responding to this. They're showing some level of awareness that they are now concentrated in this, mega cap growth technology index is what it feels like almost at this point. So we have seen actually some underweights in large cap. So we have, a portfolio team that looks at these portfolios, and they've been able to see that there has been some increase in small and mid caps that have been able to be introduced, and we think that that's really important. And we have tools to help them with that too, right? The one thing that's pretty compelling is the S&P Completion Index, which is covered by our fund VXF, our Vanguard Extended Market ETF. It's basically the total stock market less the S&P 500. So what you get there is naturally some small cap, mid cap, even micro cap names in that extension of that index. It actually has a little bit of a value tilt to it, so it can help kind of diversify your styles. And then, the other part is just the sector diversification is much stronger in there. We see just a better allocation to industrials, to consumer cyclicals, to healthcare that joins finance and obviously technology as some of the big sectors. So, buying something like VXF, if you want to protect yourself from maybe realizing gains, if you have it in a taxable account, that's a good way to use maybe new assets that go into VXF to kind of get yourself more diversified. If you're new to the products altogether, then I would highlight VTI as well as our total stock market ETF that just gives you a natural market capitalization weighting across the entire index so that you're going to have whatever the US stock market is and invest over 95% of those investable securities. So it's just going to naturally give you kind of the whole market and not position you in a spot where you're really overweighted into the S&P 500 space.
Right, that's like the all-in-one solution, if you will, for the US stock market.
Absolutely, yeah, it's a great tool for that.
Yeah, and we've seen, already this year, right? We've seen the breadth of S&P 500 performance start to increase just within the first,
It
30
is.
so days.
I think we've been due for, small caps and mid caps to have some outperformance as
Yeah.
well. We could talk about diversification off of US shores too, and the importance of having some international components in your portfolio, but just focused on US equity alone right now. We have, again, seen clients start to react to that. It's a good thing. And, well, rates can be an impact for small caps too. If we do see rates come down, those financing, charges that they rely on to grow their company could be impactful.
Yeah.
So, I think that leans to a strong pointing to value and small caps specifically that have kind of been a little bit in a coma over the last few years.
Yeah, of course. Yeah. So, we could kind of talk about this all day long.
For sure.
But, so there you have it. The income and fixed income is back and balancing out the overweighting of S&P 500 large caps by venturing into mid, small, micro-sized caps could be a good way to ensure proper diversification. Got it. So if you didn't read the Q1 ETF Perspectives yet, click the link in the post and we'll see you next quarter.